people don't want to buy stocks in the UK. And so like there's this, they're trying to change one of them. They're trying to make the regulations such that more stocks want to list. But
Yep.
there's just still something like when I think about the UK stock market, I think about like a fish and chips joint in the corner. And I'm like, I don't know.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Hey there, my man.
Are you ready to look like a fool in front
Every
of a bunch
day.
of people? Yeah.
Every day.
So excited for this.
Okay. Well,
I
just
just
like
want
no
to jump into the
pleasantries.
quiz.
No pleasantries
I mean,
today. Okay, go for it.
I think you're going to do well on this. All right. I was
Okay.
playing with some numbers. There's a long story behind it, but don't even worry about that for now. I was playing with some numbers on basically dividends and how
Okay.
juicy they can get
Ooh.
when valuations kind of come back to earth.
Oh yeah.
I looked at some scenarios, and I'll let you play with. We can put in numbers here and do real live analysis. But I looked at some scenarios of someone putting money aside every year, that growing at a reasonable rate, having a reasonable dividend.
25, 30%.
And my question, was like, at what year, how long would it take for your dividends to be greater than the total amount you're contributing? Because then you're doubling up, right?
Yeah.
So I'll put some real numbers behind this so it's not too vague. Let's say someone put aside $100 a week for a year,
Okay.
$5,200 a year as contribution. Again, that number doesn't really matter because these are all scalable, right? So we're just saying, when do your dividends reach higher than that number? My initial scenario has 8% growth with a 3% dividend. And my question for you is, how many years does it take for your dividends to exceed your contribution amount?
You know what I just thought about?
What?
Remember that Tootsie Roll? There was the owl, the Tootsie Roll pop commercial.
Yeah.
How many licks does it take?
Yeah.
1, 2, and then he would bite into it. Go 3. Anyway, okay. So 8% increase, 3% dividend.
Yep.
7.
You're aggressive. This is because you're a momentum investor.
That's right.
And
you said reasonable rate of return.
Reasonable rate of return. I mean, so in that scenario, year 15, you start bringing in $5,367 of your dividend contribution. Now, on that being said, your 8% growth figure is $14,000. Like you're making plenty of money year 15. But let's just play with the numbers a little bit. You want to bring the growth rate, the return rate up a little?
There we go.
What's reasonable?
Let's go 12.
12. Okay. The reason I picked 8 is 7 to 10 is pretty, that's a ballpark number.
You're going historical with it. Going historical.
All right. So here, same numbers, yearly contribution, $5,200, growth rate on your investments of 12%, 3% dividend. We can play with that number too. Believe it or not, that only brings you up to year 13, although year 12 gets pretty close. More like year 12 and a half.
Okay. Interesting. But then I'm sure after that, it really
it ramps like crazy. It ramps like crazy. Yeah. So here's where I'm going with this. We can play with more numbers, but I hadn't looked at that exact question. When do my investing returns that show up in cash exceed my contribution? For some reason, that's an interesting question for me, because realistically, you could say I'm putting aside $5,000 a year for 15 years. And then on year 15, if this is like not your retirement savings or whatever, you could be like, I'm actually not putting aside $5,000 anymore. And your investments would put aside $5,000 for you. Or you could say, you know what, at that point, I'm just cool, like riding the growth wave, and I'm going to pull my dividends out. You get a $10,000 raise on year 15 for the rest of your life. You don't have to do anything. It's pretty amazing, some of these things that happen in compounding land, but none of it really starts to get like noticeable, interesting, starts to feel life-changing ish. Like you're not at year 15, it's not life-changing, but at year 30 it is. Anyway, I think it's fascinating. 10, 15 years in, that's when you really start to go, oh my goodness, what's happening?
Yeah. The power of compounding, as many times as it can be said and heard, the power of compounding never ceases to amaze me, no matter what. Like I know it intellectually, but I'll give you one. This is a little bit different from that, but something that just hit me recently. And then I'll give more of a compounding example from a book I'm reading right now. It's a classic, but so the thing that hit me was Broadcom. Now, this is an exaggerated point a bit because Broadcom is such a large part of my portfolio. So it's not like a reasonable
Yeah.
situation that I'm in. But Broadcom, roughly half my portfolio at this point. It's ridiculous. And pays a decent dividend. It's like 2 to 3% dividend for a stock that also grows pretty solidly. The quarterly Broadcom dividend that I get is larger than many of my other stock holdings.
Don't you
It's
love
like
it? Don't you love
it's wild. But to your point, and this isn't it's not a long period of time, but we've owned Broadcom for years now, 5 years, something like that now. And so it's grown into this position, but yet and still, but that is just it's kind of bewildering to me. The thing I read, so I'm reading Smart Women Finish Rich. You ever read that book?
No, never even heard of it.
It surprised me at it's one of those books that has a good amount of the like classic, I won't call it theory, but like principles of investing. So like nothing new there, but also makes it tangible. So it has tangible tips. Some of them end up getting outdated because things
Yeah.
change, but regardless. But one of the things that it showed, and this you've heard a version of this many times before, but it has this example of someone at the age of 14 putting like if a parent opens a custodial account for them, let's call it a Roth IRA, and from 14 to 19, I think that's what it was, puts in $2,000 a year. So 5 years, $10,000. Then it compares that to someone at the age of 19 starting to put $2,000 a year in.
Yeah.
And let's say they stop at 27 because for whatever
Yep.
reason they do. And then they have someone at 27 putting $2,000 a year in for like the rest of their life until 65.
Very classic example.
Yeah.
People slice and dice this all the way. Yeah.
Exactly. Classic. But it still bewilders me that so the person from 14 to 19 is never caught. Like the other two people, the money never catches up. And really, if you take like, I mean, that's $10,000 they put in. And by the time they're 65, if you take, historical returns, it's something like $1.1 million they have when they're 65 from the $10,000 they put in. And then the person that's 27 has to put in $2,000 a year for 60 years, sorry, for 40 years. Like that's such a long period of time that it's bewildering that like it never gets there. Anyway, compounding, so powerful.
But it really is this concept. It's going to my first example. It's like, well, if you reinvest the dividends, which most people would, then all of a sudden you're not contributing $5,000 a year anymore. You're contributing $10,000 a year.
Yeah, exactly.
And $50,000 a year. And that like it just explodes. It's classic. That example you just brought up gets me a little riled up. You didn't think this was going to be controversial.
I like it.
Because in a way, especially when you start to talk about someone at 14, you're just hacking the math. One, it would be tough for a 14-year-old to probably come up with $2,000. Two, I think it's important that kids are actually allowed to be kids. As much as I admire the 14-year-old that's wearing the tie and the pen protector in their front pocket and everything, Alex P. Keaton in it, like you'll be all right, dude, if you have a little fun. If you buy that Xbox, I'm just saying.
Not disagreeing with that point. However, this year for my 10-year-old, he'll be 11 this year. We're opening a Roth IRA account.
Mm-hmm.
And he will not be he's not going to Baskin Robbins to work to then save to do this.
He should be. We need to have a talk.
No, he tried to go to Chipotle. He said, take me to Chipotle and get me a job. But as they expressed, you have to be 16. Anyway, so but the point is really learning about investing, and where the money is really coming from is from us. And it's not going to be $2,000 because the way that it works, so folks know, if you have a custodial IRA account for a minor, you can only, this is true for adults too, but especially true at this age, you can only put into an IRA the amount that you earn. So if you only earn $1,000 in a year, you can only put $1,000 a year in. And so for him, it's not going to be $2,000. But when he does stuff like around the house and, we give him money for it, it might be like a couple $100 and we'll just put it in for him. But at least he'll be able to understand how stuff works. So I think that I get you with the hacking the math, but I also think that if it's possible for the parentals to do that, great. I agree that a kid should be a kid at the same time.
No, and so that's exactly what I would have said. I would have said, if there's any way to teach your 14-year-old about money, and maybe they have the job at Chipotle, but also you're like talking to them about stuff around the house or whatever, or there's a way for the parents to put 10K in an account, and so by all means, like, but let a kid be a kid, if possible.
Toys R Us.
Because
Toys R Us.
Because what's that one song? It's like basically you're born, you worry about money, and then you die. Like sometimes I feel that these finance books are all about all you could ever do in life is worry about money. And it's like, maybe you should live too. I'm on a rant. Sorry.
Usually when someone says, that song that's about, and then I get it. But what you just said, you're born, you worry about money and you die.
I think it's
that's not a song.
Symphony or something. I'm just not going to sing it.
It's not a song. All right.
It's a song. Okay. All right. I have one revision on I thought you'd go here, but you're a momentum investor. One revision. If we grow at 8% and find stocks that pay a 5% dividend, it's basically year 10 before we're making more in dividends than we're. It's so tangible now. There are decent stocks out there with quality balance sheets that pay north of 5% dividend if you wanted to go that direction.
Are you, for the sake of this math, I don't know how simple or complicated you're making it.
Simple.
Okay. So you're keeping the dividend rate the same even when the stock price increases?
Yeah.
Okay. That's fair. It's the conceptually still the same.
I mean,
the math
it's
will just
like
be different.
think of this as investing in a basket of dividend aristocrats that frequently raise their dividends on a yearly basis. So interesting stuff. Compounding is great. That's it.
Oh, love it. I'm going to start off with one of them, but the stuff I'm going to talk about today, I can summarize it all up as Wonk and Circumstance, because it's boring. There's boring stuff in here, but we're going to talk about it, try and make it more interesting for y'all. I'm going to start off with this piece you sent over to me from Morningstar. It's called Should Your Stock Portfolio Consider Your Career?
That was the worst intro to a topic I've ever heard.
What, Wonk and Circumstance?
They just called it boring. It's actually interesting. We are going to pull out all the boring stuff
and talk to you about it.
Okay.
Oh, okay. Yeah. No, we bring up these papers, this one's 35-page research paper. We bring this stuff up. I think y'all love it. The concept of this is actually fairly simple. And it's just in the question there. It's when folks are typically when we as a society, we talk about stock portfolios, we look at someone's stock portfolio, we look at our own stock portfolio. Oftentimes what's communicated is within that portfolio, make sure it's diversified, from an industry perspective, from a concentration perspective, et cetera. But how do you think about your portfolio in relation to your day job and other, as they call it, non-tradable wealth you might have? So how do you think about your stock portfolio with regard to your real estate, with regard to the stock you might have in the company you work for, and your human capital? That's what this piece talks about. They go through the wonk that comes from it, goes through a whole bunch of math as to how to optimize this. We're going to skip the math. It's not about the math. What it's about is the concept of it, which I think is interesting and not boring. Let me go to that point here.
I mean, I think it's about pretty much just a little bit of common sense when thinking about how your paycheck comes in the door, thinking about the risk associated with that and making sure that your investing risk isn't like in the exact same bucket, because then you're pretty fragile. Your investing life is pretty fragile.
That's right. That's exactly right. So if we give a simple example, this is not from the paper itself, but if you give a simple example, let's say that you're a director plus, so like upper mid-level leader at Caterpillar or some construction firm.
Okay.
And then you put together your individual stock portfolio that's separate and you invest in John Deere. If you have investments that basically just match what you're doing at work, then it's saying that's you're still just you're further concentrating yourself into the whims of that particular industry. So
Or
think
where I
about them
see
together.
this is kind of like the realtor that owns a bunch of real estate. And I
Yeah.
understand.
Yep.
Why
That's great.
they own a bunch of real estate, because they feel like they have a special edge there. But I don't want to be hyperbolic. A fair amount of people that have had that concentration in one specific industry have had luck turn and have ended up in a tough spot because there's just no counterbalance to the risk they take.
Yep.
Now, flip side is if you get lucky, you're the right place at the right time. You might be rich. You might be absent of skill and end up rich simply because of luck. But if your goal is to diversify here, we should make sure you're actually diversified.
Yeah. And I think yours was a much cleaner and easy to understand example. And so let's even put that into some historical context. If in the year, let's call it 2000, let's say you were in the tech biz, you were like, I'm .com and all up in this ish, and then you lose your job. So you're like, okay, what am I gonna do next? Let me get my real estate license. You get your real estate license. Maybe you get a little inheritance. So now you're a realtor. Oh, real estate starts taking off. So you get a little inheritance, you start buying some properties, and you're in the real estate market. And then you're like, ooh, more properties, more real estate. You're selling, you're selling, you're selling. 2006, you're like, genius level. I'm about to put some courses up on the interwebs so people can buy this. There's this new product came out called YouTube. Boom, I'm gonna put myself on YouTube. And so you're boom, bomb shakalaka. You start telling all your friends about it. Everybody gets into real estate.
Yeah.
2007, 2008. Now you're sitting on the corner eating graham crackers. That's what you're
Depends
talking
on
about.
those prices you got in. Maybe you got in 2000 at the right price, but
Okay, maybe not graham crackers. Maybe you couldn't even afford graham crackers. You're sitting on the corner with Dollar General generic honey grams.
but
All
then
right,
you're buying
anyway,
some of
we
that
get the
Dollar
point.
General
We get the point.
stock and you're good. Yeah, I mean, that was how I summed up the 35 pages, but I don't want to.
Yeah.
If you want to dive deeper, by
No,
all means.
no, I think that's good. I'll give some info on the methodology. So, and we'll put this on the Substack on Monday, skippydoogles.substack.com, so you can check that out and read more. But what they did in the paper was they looked from 2013 to 2022 and took data from about 250, was it 263 firms in the US. And they said, if you look at the individuals that it's cross industry, if you look at folks during that time that work for some of these firms, and you take the human capital point that I mentioned, was you take future compensation and discount it back, and you discount it based on typically like interest rate stuff and the likelihood based on the different firms that firm would be able to pay you money in the future. So like likelihood of default. If you look at that, you get this human capital number. Then they have a certain number, I think it was about 15% or something like that, of typical compensation that comes in the form of stock. So like, what does that look like? And then real estate holdings. So they took all this math and then used data from the BLS and CompuStat, et cetera, to figure out what returns would look like based on the different elements if you optimize based on total wealth versus a simple portfolio. So that's what they do in this PDF here. We'll put it out. It is summarized well from what Skippy said, though. If you're a realtor and you're buying a bunch of real estate, ooh, that's going to hurt you. Now you're on the graham cracker train. So that's going to hurt you more so than if you diversify. That's what they're saying.
Yep. The most classic example of this for me, and something I get asked frequently, maybe even monthly, is like, should I buy my company's stock because I get this discounted stock purchase plan? And it's like, maybe, but probably not. Like we can look at the valuation of your company's stock. We can see if it's a great deal. If we think it's a great deal and you get another 15% off, like maybe that makes sense. But the biggest picture here is probably you already have all your employment risk with that company, and you don't want to load more risk on top of it when it costs you money. It's another thing if you're getting stock grants or RSUs or whatever else. But
right. Yeah, this was my life at one point. I'll just tell a personal story, although it was with like tens of dollars. Because when I first started investing, I was working at Red Robin.
Yeah.
Red Robin in July of 2002 went public. Boom! I was like, I'm taking all my wages from like the week, buying some Red Robin stock. So there I am. leveraging my future on the smiling burgers in the daytime.
Yeah, I mean,
And
gosh, back
yeah,
in the heyday, it was a thing, man.
oh man, it was a thing. Oh, I
Yeah.
loved owning Red RRGB. Oh my goodness. Yep. So there we go. I don't own Red Robin anymore, but I could have been that person eating graham crackers. All right. Next for you in the fishbowl.
This is a choose your own adventure. Do you want to talk about crazy stock volatility and some fun I'm having, or politics?
I'm going to go with option A.
Perfect. What was it? 3-4 months ago, I pitched, I think I could say, a stock called Hawaiian Electric.
Yep.
Very simple pitch. It
Very.
was the stock used to trade at 30 to 40 bucks a share. It was currently trading at about 10. That was about as logical and rational as you could possibly be, because there was thought that they may have a wildfire liability relating to the Maui wildfires. And my pitch was based on everything I've read. I think they might have some wildfire liability, but certainly not the whole enchilada. And basically, their market cap has dropped by more than the total double or triple what I think their actual wildfire liability is. Really solid company that effectively sets rates with the Hawaiian government. My pitch was basically, if you're the type of person that says you want to own a monopoly at discount prices, this is something you got to look at, because they supply 95% of the power to the state of Hawaii, and there's no one that could even replace what they do. Like, they just will do that for the next 30 and likely 100 years. So here's the deal, Doogles. It went all the way into the sevens. It's trading, I think, at its lowest at like 774. And me, being a wise investment gentleman over here, was like, you know what? I still believe my hypothesis, but the market sentiment on this is poorer than I expected.
Yep.
And there's more bad news than I expected. So instead of just, I had been building my position over 2 months or so and had a decent amount of money in there. But a stock like this, you can never have, this can't be a Broadcom, right?
Yeah.
Because even if you feel like the probabilities are in your favor, you can't put the majority of your wealth on something like this. It's still a little bit of a lotto ticket, despite the fact that I think there's logic behind my investment approach.
And
so,
agreed. And
yeah,
the text that I sent to you that you rightfully laughed at was, because this is what I was debating. I was like, ooh, maybe, when I was around 8. It's like, oh, maybe a little bit. I said, I almost have no doubt, that's hard to really say, but I'm gonna say it here. I almost have no doubt that this will get back to 30. And what I don't know is, will it go bankrupt before it does?
And for those who don't know, going bankrupt would be bad for the equity holders.
Yes.
So, long story short, I decided, like, I'll build my position over the course of maybe 12 months instead of just throw a balloon in there, because it's hard to catch a falling knife. We talked about this earlier this month. And in my brave wisdom, that was a poor decision. So I don't have as much money in this position as I was like, but here's the fun story that we get to talk about on the show. Now it's trading at $17.50. I think I'm up 105%, something like that.
Yeah, like in a week.
Basically, yeah. Certainly since I started building this position, gosh, we were in Omaha, basically. It's been 3 months or something. I mean, not a long time. And the thing about all investing really is, like, but especially deep value investing, is like, you're probably pretty confident it's going to go up, but you don't know if that's going to take 3 years to happen or if it's going to take 3 months to happen. In this case, my question for you is, like, what do I do? I'd gone into this just being like, this is going to be a long-term holding for me. I'll build a position over a year, and 10 years down the line, it'll trade at 35 bucks and pay a nice dividend, and I'll just forget about it. But now when you get this big jump, you always go like, well, what's the opportunity cost? Should I take this money elsewhere? And here's the deal. This is going to go back down. Like, the volatility is here to stay with this thing. It's not like it's just going to ride out its merry way to 30 bucks a share. That's not happening.
I assume this is in a taxable account.
I have some in both. Yeah.
Because it does, the calculus a little bit for me does change a bit, because short-term holding, if you sell it now, you're going to lose, let's call it 35 to 40% of the.
Yeah, that's fair.
right? Of the value. So then you say, so my 17 is really closer to 13.
Yep.
Right. Give or take when you take that amount of money out. And so that starts to become the calculus, unless if it's in a tax deferred account, that's a little bit different. This one, depending on what the percentage holding is, I think this is the case to take it as a flyer.
That's exactly where my head is too. Like I said, it's a smaller holding than I would like because I got smart with it. Maybe I actually was smart with it, or rather than my sarcasm there, because this was always a little bit. I mean, I think the chances of it going to 4 before it went to 17 were just as great as the chances of it going from 7 to 17. Like,
well, apparently not. It was 100% chance it was going to go to 17.
In retrospect.
In retrospect, yeah. I take it as a flyer.
I like that. I think I'll do that. I actually think I will continue to build my position over the next 12 months. That's I think like so monthly? Because I really monthly, yeah.
Okay.
I really do not expect it to stay at 17. For those who don't know, it went to 17 because there's speculation that the wildfire settlement is going to be very favorable to them, in which case it's a $30 to $40 per share stock pretty much, but we'll see. There will be lots of twists and turns on that front.
To give folks, and this means only what it means for the story that I'm telling here, to give folks some historical context, the last time that Hawaiian Electric was at this price was in August of 2009.
Yep.
Because even when it dropped down from 40, it skipped this price. It was never at this price. It went from 40 to like 14. Do not pass go, do not collect $200. So the last time it was at this price, 2009.
Well,
that I could see.
Better, like that you're talking at 17. The last time it was around $10 a share was 1985.
Oh yeah,
I mean, like, so that was my hypothesis at 10 or 8 or $7 a share was like, guys, this is utility companies are about as boring as they get. You're never going to get outsized returns in the long term. Anyway, I'll keep you in the loop on that.
Yeah, please do. Good for you. Good for you. I like it. I like it when these things start to show promise, at least. Let me not get ahead of ourselves. Show promise of beauty.
It's kind of hilarious, though. It goes to the compounding stuff where you can like have a good week with certain things and be like, wow, that's a decent chunk of change that just like magically appeared on my doorstep. It's fun.
Yeah. And it can be a little bit, to go to somewhat hyperbolic, it can be a little bit anger inducing sometimes when it happens like this. Because if we were talking, if you went from, let's say you got in 8, I'm making up numbers here. Let's say you got in 8, and then we're talking 2 years from now, and it's in 17 to 20. That's such a different conversation. You'd be like, oh, doubled my money over the course of that period of time. You probably would actually even have a larger position, closer to 8.
Totally.
And so the decision's different. When it does this, it's kind of like, crap, like, why did you double in a month? Like, could you have done this over some extended period of time? But no, the Hawaiians refuse.
Well, this actually really reminds me of when I bought undervalued stocks in the past that I knew were like on a 24-month run to get back to what I thought was true value. And then someone acquires them at a 100% premium or something, and you make all your money in weeks. Yeah. It's always like a little jarring. Again, it's like great, but it just feels so out of body or something.
All right. Fishbowl time for Doogles. We talked last week about the national debt. I'm about to talk a little bit more about the national debt, but from a different angle this time. The beginning of this Wall Street Journal article, which is called How Wall Street Keeps Absorbing America's Borrowing Binge. The beginning of this says, the U.S. fiscal outlook is deteriorating. Wall Street doesn't seem bothered. I'm going to give a little more flavor. What this piece is about is how the U.S. all-time high debt, right? We talked about that piece. We talked about that. But when a country like the U.S., or, you know what, let me be more specific, a country that is the U.S., when it goes into debt, that means it's issuing bills, bonds, whatever they might be, and someone's buying them. And so the Wall Street keeps absorbing America's borrowing binge point is answering the question of who's owning this debt and what does the dynamic of the market look like? I'll give the summary. I'd love your take, which might even be who cares. But here's the summary. So one, there's a lot of demand for these treasuries as we're putting them out there. And a part of that has to do with we're in uncertain economic times. That's kind of broad. And so investors are like, cool, it's safety. I love it. We have institutional investors. So we got insurance companies, pension funds that are buying a large portion of this debt. We have foreign organizations, entities that are buying large portions of this debt. So central banks of other countries, sovereign wealth funds of other countries are absorbing US debt. And then you have the other side of it. That's what does this potentially mean? Because in some worlds, in some perspectives, you could say there's a lot of fragility that sits here when you pump out this much debt this quickly, and folks are looking for safety. There's a bet that if you pump out more debt, more folks will buy it. But there's also a chance with the geopolitical risks that we discuss, etc., that the same demand doesn't exist in the future, or that folks start selling what this looks like.
Yep.
And so it's kind of because of the size of it. There was I didn't write this down, but I'm going to get this somewhat directionally correct. In this article, it talks about not the total, it talks about the total volume, but it's not just about the total volume. It's the liquidity of the market and how much money is actually trading hands here. And it's massive. Let me actually pull it up because I want to give this the specificity it deserves right quick. The US is not the only place that is viewed as safer. It states that Japan and Germany are other countries where people generally say that their debt is safe. But the volume difference between the US and Germany is specifically what it compares to. It says $190 trillion of US treasuries were bought and sold in 2023, more than 7 times the size of the market. Trading volume of German government bonds totaled roughly $7 trillion, or 4 times the amount of bonds that were outstanding. The liquidity in the US market is kind of sick. And I hadn't thought about it in this way before. This is really interesting. You know how the dollar is the world's reserve currency?
Mm-hmm.
Well, this was suggesting, like, really, maybe it's not that the dollar is the world's reserve currency. Maybe it's that treasuries are just the dominant reserve asset. So it's about the liquidity of this market that makes it more important than the real like value or trust or faith in the dollar itself. Same outcome, but I think that's really fascinating.
Yeah, those things are co-linked. I mean, when people talk about what may be the world's reserve currency in the future, one of the biggest drivers of that is simply liquidity. And there's very few countries that could even meet those demands. I don't know. None of this surprised me. I wouldn't say I don't want to sound like a jerk, but I'm not sure that I learned anything here. I just think it's funny. It's almost like a really clever plan that we convinced, or maybe the world has convinced each other that all of the Western economies can run strong government deficits at once. So despite the fact that we should be more concerned about the safety of the US debt, you should almost be more concerned about the safety of the countries that might be good alternatives to US debt. So we still are the dominant player.
So I can see where you'd say there's nothing learned in the detail or the facts, or maybe you just learned nothing at all. Maybe there's nothing learned in the detail or the facts.
I don't mean nothing.
What I think is important here to think about, not to act on any of that, but to think about, is we've discussed a few times on here how, generally speaking, when an economy or a market takes a turn, it's not because something different happened during those times, but they happen at a time where things are more fragile.
Yeah.
And so much of markets and economic activity is based on confidence, faith, whatever you want to call it. And this is another area where there's a lot of faith that's holding up a market that is at whether fragile or not, maybe I shouldn't use the word fragile, but it's at a point that is certainly not robust and strong. And it's interesting to think about because I think this is probably the side of national debt that I think a lot of people probably don't think about. What we talked about last week with regard to you have national debt, you have interest rates, there's the cost of servicing that interest. That's one side of the danger of it. And the other is that the market as a whole is upheld by faith internationally.
Yeah. I mean, I have no doubt this will change and that economics will eventually catch up to this because I think there's more demand than might be logical at this point in the cycle. What happens when it changes is very interesting. And that's like a whole different, that's a 3-hour podcast.
Mm-hmm. Cutting rates from a debt servicing perspective, cheaper. Debt's now cheaper when rates get cut. It also makes the treasuries much less attractive.
Less attractive. I mean,
depending on how far we go. Depending on how far we go, yeah. We're not going to get too buck wild, hopefully. Come on, Powell.
Yeah, come on.
I got Glenn Powell in the movies and Jerome Powell, and I can't take all the Powells.
I'm going to add to this. It was announced this week in the Wall Street Journal that Elon Musk is spending something like $45 million a month backing the Trump campaign. There are rumors, maybe this is set in stone, but there are rumors that Peter Thiel and others with big net worths in Silicon Valley have also jumped on that side of the train. Perfectly fine. Mark Cuban and Elon Musk do not get along. They have not gotten along for a long time. So I may be headed into conspiracy theory land here, but I thought this was just fascinating. After that comes out, Mark Cuban puts this hypothesis out on X, Twitter, and claims that some of that crowd owns a lot of Bitcoin. And the desire to back President Trump is because they think he will devalue the dollar, which in a roundabout way will make their Bitcoin holdings more valuable. The purchasing power of those go up. I don't even really care. We don't have to talk about the specifics of any political campaign or Musk or Cuban or anyone else. I think this is like the basis of a sci-fi movie or something. I find this so fascinating. It's like it's July 4th and we're watching Independence Day 2030 or something. And the whole plot is like these billionaires get together because they own a bunch of this cryptocurrency. Someone could have wrote this plot in 1984. My mind would have exploded, right? They don't need the US currency anymore because they have these computer things over here, and then they have this real money which they think doesn't have much value, or they won't have much value in 100 years, so they're going to blow all that value for a political candidate that will enhance their wealth. Fascinating. I love every part of this conspiracy theory, and I want your take on it.
The Bitcoin theory itself, I don't know. I look, Mark Cuban has logic. It's, if nothing else, it's humorous from a sci-fi standpoint.
Yeah.
What I will say is this, maybe this is an abstract conspiracy point. There are so many people in this bucket of tech people, billionaires, whatever, Elon Musk specifically, that we joked about Chamath and his turn. There's so many people that feel or are expressing such like buck wild Trump support right now that expressed buck wild Trump hatred 4 years ago. And I get the thought, as you stated, I think people should adjust their like mindsets as you learn more information.
Yeah.
But the reasons that I saw that people expressed dislike, hate, whatever it might be for Trump for these people 4 years ago, those attributes have not changed. Like the same attributes that they did not like are still exist today, whether those attributes are right or wrong, right? Different people can have different views on those. So then it makes me go, what has changed? There are logical reasons why people have flipped so aggressively to the other side.
Because everyone's logical in their own head, right?
Exactly.
That's a fair assumption.
Yeah. And so something is happening, whether everyone's working together to put Bitcoin up or whatever, I don't know, but something has flipped. And I think take Biden out of it, because it's easy enough to, I think, to say like, oh, can't vote for that guy. But it's not like that's not what the rhetoric is. It's full support of one side.
Biden almost doesn't matter. Like I was trying to make this generic because I just hate talking about politics, but there's part of this that's the syndrome of the backup quarterback is the most popular person in town always. So like whoever is currently quarterbacking the country, it doesn't matter on what side. Like it's always so much easier to be like, oh, I remember, I'm nostalgic about a past time when there was a different person. That's the backup quarterback. That makes sense. There's people just get sick of the status quo.
Yes.
In addition to this conspiracy theory, or at least as I'm calling it, it was really bizarre that 2 weeks ago or something, the Bitcoin main conference, I don't even know what it's called, announced that President Trump was the keynote speaker. This is something that happens before the election. Again, I don't know the exact timing, but that raised an eyebrow to me. And then shortly after that, that's when it's been more public about some of the support from these people that seem to have been really bullish on Bitcoin.
Dun, dun, dun.
Could someone at least make the movie? Could someone make Independence Day 2030?
Yes.
With okay, so then maybe I'm beating a dead horse here. Here's I think the heart of the thing is, has this always happened? Have there always been the Vanderbilts and the JP Morgans, or like have these the Rockefellers always behind the scenes? Have they always been playing politics in a way that I'm just not aware of? And so this is just story as old as time.
Yeah, Angela Lansbury. Yeah.
Okay. Interesting.
Absolutely. This one just fascinates me because of the point that I raised there, that it was about the attributes of the human, why people were pushing back 4 years ago. That human is the same. So now it's not about the human, it's about something else, which might be Bitcoin. It's probably something else is likely money.
That something else is 90% of the time money in these circles, right? I mean,
yeah. Whew. All
okay.
Right.
So on politics and money, there's just one more thing we need to tie in.
Okay.
I find it hilarious. We're not going to talk about it. I find it hilarious that JD Vance, who the best joke I heard this week is that his real name is actually Dance Vance. For some reason that just makes me laugh. I don't know what his real name is, but who cares? He left his Venmo public. So there are articles out there, like there's one in Wired magazine that goes through, these are all his friends, this is who he sends money to, and I find this absolutely hilarious. He could be the vice president of the United States, and basically he gave the Rolodex of his contacts in his phone from the time he signed up to Venmo to the entire world.
He believes in transparency.
He does not. So a friendly nudge, regardless of if you think you're a future vice president or not, just turn that off. It doesn't. That doesn't do anything good for anyone. There's no reason to.
Absolutely.
So then your right-leaning paper is going to spin that into something positive. Your left-leaning paper is going to say, "Oh my goodness, he's almost connected to some Russian diplomat that's a horrible person because he sent money to this person who sent money to this person who sent money to Putin for all." Like it's just hilarious to see the articles that get written about this.
Yeah.
But JD, come on, man, just turn that thing off. Apologize and move on.
All right, I'm gonna wrap from my side at least. Fishbowl, UK stocks, no one wants them, and it's sad. Oh, I don't know if it's sad, but it's interesting.
If they had any decent companies over there, I'd take some.
So they have decent. What are you talking about? They got decent companies.
I'm joking, but
we
I've tried to start a position, and it's harder than you might think.
Because are you trying to not? So you're trying to start not like an ADR position, but an actual.
No, so basically, I wanted a basket of dirt cheap UK stocks because I didn't really want to go like company by company and sort through all the junk. And I haven't found anything great, but maybe I've missed it. Maybe there's an ETF out there or something. Go ahead.
So this is another Wall Street Journal piece, which raises a great point that a stock market has to be able to attract stocks, and somebody also needs to want to buy those stocks. And what's happening right now in the UK, it's been cheap for a hot minute over there. We discussed, I think it was in 2021 on this year podcast, we were talking about how UK stocks were cheap. I've been watching UK stocks for a hot minute. They're just like cheap and boring. But anyway, we've been discussing how they're cheap.
No, I hate to interrupt. That is true. Like some reason they're just boring, man. Like I cannot get excited about anyway. I guess technically Diageo's headquarters is in London, and I have some of that. But other than that, I just cannot get excited about any of these companies.
It's the truth. And so there's the two sides of this. There's one where the stock market itself, the rules and regulations, according to this piece, were such and are still such that listing there is less attractive for companies that want to go public. So they choose NASDAQ or they choose Hong Kong, wherever they might choose. And people don't want to buy stocks in the UK. And so like there's this, they're trying to change one of them. They're trying to make the regulations such that more stocks want to list. But
Yep.
there's just still something like when I think about the UK stock market, I think about like a fish and chips joint in the corner. I'm like, I don't know.
I'm good. I've
Yeah,
had enough fried food today.
I'm okay. When we talk cheap here, so let's go relative to the US. S&P 500 price to earnings ratio right now is 22-ish, somewhere around there. The PE ratio in the UK, excuse me, is closer to 12, 13. So
Half price, baby. Yeah.
half price. And it shows, I don't know how cherry picked this is, but it's good for a story. And the chart that's in this, it shows the change since the Brexit referendum. And since Brexit, and really since 2020, but since Brexit, there's been a widening gap between the US and the Brits with regard to price earnings ratio.
And there should be, because, at least in my eyes, because 25, 30 years ago, you would have gone to London as the financial center of the Eurozone.
Yes,
the
exactly.
European region. And then Brexit, you go, that's less and less true because they're less connected to Paris and Madrid and Barcelona and Rome. Like that makes sense to me.
Agreed. It's its own separate thing now. I want something to feel cheap there. Like the story of, sorry, now I want something to feel cheap. I want it to be cheap and then rise, because the story that I can create that gets my lips juicy is one in which there's ultimate, I'll call it pessimism. It's a little bit different here, but just distaste. Like this is ultimate garbage stock market. And if that turns, there's an automatic reversion to the mean that you can see, like huge gap with all kinds of margins of safety. And that sounds great. And then there's the other story that's just you fast forward 15 years and it looks the same.
I'm not an expert in the United Kingdom economy, but it's like you said, there's very little from an outside perspective, this side of the Atlantic, that gets me excited about the current prospects, or for that matter, the future prospects. If Brexit was completely reversed and they were smart about investing in the country, I mean, it's in this graphic. It breaks down all the countries with their economic center and then shows you what the median standard of living is like in that country if you remove the economic powerhouse from the country. The UK one is absolutely fascinating. So you have like Paris without France, and you have the United States without New York City,
yep,
and etc. For most countries, that moves the median standard of living down slightly. For the United Kingdom, if you take London out of the equation, it moves the median standard of living down to like Mississippi levels. Like outside of London, there's nothing happening in the rest of the country effectively. There's no economic engines. There's no great profit drivers. I'm being hyperbolic here.
Man City
for that. Yeah. Have you been to Man City? Because I've been,
yeah,
and I wanted to get out of that place
good.
as soon as possible. Right? If you're not watching soccer, you're getting out of there. I think it's a problem.
Yeah.
I really do. And this will be fascinating to watch. It's time for a trip to London for me. I'll go do some research, but
please do.
I just am not super excited about what's going on over there.
I'll give you the last stat from this piece to wrap it up. Britain's own insurance and pension funds only held 4% of domestic listed shares in 2022, down from 46% in 1997.
That's what I'm talking about. And the number of initial public offerings in the UK pre-2010 used to average like somewhere around 80. And in good years, more than 300 companies would IPO in the UK. And lately, the past couple of years, it's been like 20 companies IPOing in the UK.
This, if a trends currently continue that we joke about, this is a joke, by the way, but trends currently continue that we joke about before with NVIDIA and its executives, we'll be able to say some similar thing to this in the future, where we go, NVIDIA's own executives only held 4% of their net worth in NVIDIA in 2022, down from 46%.
I thought you were going like NVIDIA's top 10 executives their net worth is equal to the top 10 stocks in the FTSE 100.
Oh, that's probably true.
Mean,
that's probably true. You got anything else?
Come on. We need our friends in London to get it together. Come on, guys. That is it. So, guys, all things Skippy Doogles are at skippydoogles.com. We are debating moving to YouTube. If you're especially interested in that, please shoot us an email. And other listener mail can also go to skippydoogles@gmail.com. We'd love to hear your thoughts on that. Anything else, Doogles?
That's it.
All right. Peace, guys.
Bye.